It's going to end badly. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the Fed is losing control of the financial system, which signals a major disaster for the global economy, suggesting that we are headed into a financial crisis. At the same time, we now have further data that shows the global economy is contracting, which also means that we could face a synchronized global recession all at the same time. But what is really concerning for me this week is we just got some news from the U.S. consumer, and it's not pretty. Let's over to Zero Hedge, where we picked today's story up with a headline: Fed emergency bank loans soared as money market inflows continue to surge. Now, as we suggested weeks ago during the banking crisis, that this would appear to be a solution, that the Fed and all these other government agencies would run to the rescue, and it would appear to work. You know, that the calm from the storm would finally hit and everything would look okay. But one thing that we want to see in the data, if indeed the financial system is healing and getting better, what you want to have happen is the dependency on all of these lending operations from the government agencies. You would see a decrease in the need. But what we're seeing now is a shift in what the banks are needing and how they're approaching it, and it's telling us that something is still seriously wrong in the financial system. After last week's massive non-seasonally adjusted deposit outflows, all eyes were back on the Fed's H.4.1 report, and the answer was not a good sign, as the money market funds saw $18.3 billion of inflows, pushing the aggregate to a record of $5.328 trillion, which is almost $120 billion of inflows in the last 3 weeks. And we suggested that there would be further movement of money out of the regional banks, the small banks, the mid-sized banks, community banks, into the big banks. And there was a main reason we knew this was going to happen, was because the Fed was going to raise the federal funds rate, which was in turn going to push the money market rates up even further. But when you think about the bank situation, they have no mechanism to compete with the Fed and these higher rates. So you take all this negative news about the banking industry, and all of a sudden depositors start looking around and they notice much higher, much more attractive rates at much bigger banks. Well, sure enough, they're going to move their money. And here we can see the overnight reverse repurchase agreement rate is now 5.05%. This is what the Fed is paying money markets of funds. And of course, money markets are taking a bit of a haircut, but the banks cannot compete with this. So then in turn, what we are now seeing is the banks shifting how they're accessing money. And check this out. Zero Hedge shows that there's been a decrease in the discount window usage. Now, this is very short-term money. So if in the end of a crisis, you want to see the usage of the discount window decrease. The problem is the total amount of money is being borrowed hasn't really remarkably fell at all. Instead, we've seen a shift to other credit extensions, or what are known as FDIC bridge loans, surge higher, on top of the fact that the Fed's own bank term funding program is seeing an increased amount of demand. So all of a sudden, we're seeing short-term loans by the banks shift to long-term loans at a time when more money is flowing out. Now, you would think for a moment that the policymakers would start to figure this out, that in further increases in the federal funds rate are aggravating the problem here. But then you see this article and you realize they have no clue what's actually going on. Wall Street Journal reported the Fed officials signal support for further rate increases. Michelle Bowman says there's not sufficient evidence to mark that rates need to stop rising. Now, keep in mind, Michelle is a voting member of the Fed. She's in the midst of a 14-year term. She's got about 9 years left. So what she says actually matters here. And what she's suggesting is she hasn't noticed a slowdown in inflation or an increase in, of course, the jobless market or the employment market. Let's check out these two charts first and then put her to the test. Here we can see the consumer price index shown on a year-over-year rate of change, and notably, what do we see? What very clearly looks like disinflation or a deceleration of inflation. Now, what Fed officials are saying is, well, wait a minute, this isn't very fast. Now, what's odd about this problem is, for decades, and we can go back and look through here, the Fed was doing everything it could to try to create inflation, and it would for brief periods of time, and of course, in its own notes, but that would quickly turn into disinflation and then go sideways. Now that we actually have it, the issue is shifting to we need to get it to go down very, very quickly, but that's not how the financial system works. Inflation just doesn't magically appear and then magically disappear. It takes time, but the problem is they can't see the year-over-year rate of change because they're fixated on the monthly rate of change, but still over time, what we know is inflation is indeed coming down. But from the labor market perspective, well, they can't see this either, that initial weekly claims are now at 264,000. Remember, this was sub 200,000 not too long ago, and that is a big increase. Now we could say historically this is actually low, that we really don't tend to see recessions until weekly claims get to around 350,000. But we know historically when you come off very low numbers, it's not the number that matters, it's the rate of increase off that low number, and we're seeing now something very similar that transpires during past recessions. But Michelle says, well, I don't see it. Michelle Bowman, in remarks prepared for delivery Friday today at a banking conference in Germany, said she wasn't confident that central bank was making enough progress slowing down economic activity and inflation, even though she allowed that interest rates were now at a restrictive setting. So let's take a second here, because if interest rates are at a restrictive setting, let's think about it from you're driving your car and you want to slow down, so you start tapping on the brakes, but your car doesn't really meaningfully slow down. It starts to slow down a bit, so you keep putting some pressure on the brake, and finally you notice that, hey, it's starting to slow down. Does that mean you think, well, I think I need to jam it down some more because, well, I'm now at restrictive, so we need to go further? No, what we're seeing and what Michelle doesn't get is if we are indeed at a restrictive level, and if let's say that she is correct in that statement, then the smart move here would be to pause and let the restrictions of the federal funds rate at the current level do its work. But of course, she doesn't think that that's the case and is more concerned about potentially raising rates than pausing. Ms. Bowman said she would be looking for consistent evidence that inflation is on a downward path. She notes that the recent reads on inflation and employment released this past week have not provided consistent evidence inflation is on a downward path. And yet we just looked at that chart. And one of the reasons why I wanted you to see that chart is because it clearly looks like inflation is headed on a downward path. There is sufficient evidence to support that, and it is indeed consistent with what we can see through the oil markets. We see it in the energy space. We see all kinds of evidence to new orders falling. We see all kinds of ways that inflation is indeed coming down, but she doesn't get it. She says we need consistent evidence. Well, one thing you do have consistent evidence is that CTA-Timer Pro indeed helps you find which securities are at a relatively historical low level. One of the big mistakes investors make is buying high and selling low. This takes a look at how the computer algorithms run across the markets and then tells you which of these on a historical basis are low, because it goes back through time and tells you all you have to do is find the ones that got big minus numbers behind them, put them on your watch list, and what you'll find is you'll start buying low instead of buying high. It'll change how you trade. Link in the description below. Currently $30, 30-day money-back guarantee. Try it out. If you don't like it, we'll refund your money. But Ms. Bowman said she expected banks to continue tightening lending standards, which is stating the obvious, as we covered the other day, as they face higher funding costs and fewer sources of funding following the recent banking failures. She said the recent stock price declines for other regional banks were adding to that uncertainty. Notably, one thing she did not mention was the inverted yield curve, or the fact that the Federal Reserve publishes a report that we covered called a Senior Loan Officer Opinion Survey, which had this to say, as you may remember: major net shares of banks reported expecting to tighten standards for commercial industrial loans to firms of all sizes and for all categories of commercial real estate loans for 2023. So her thought that maybe banks are going to tighten standards, no, they're telling us. And what's really interesting about what we're hearing from that report is usually the SLOOS report is a look back. They tell you, well, last quarter we tightened lending standards. But now what they're telling us is going forward, they anticipate further tightening in lending standards. We know that's going to happen because we showed the relationship earlier this week between lending standards and the yield curve. But now let's look at what's going to happen between inflation and the labor market, which Ms. Bowman just totally can't see at all. And here we can see the net percentage of domestic banks tightening standards for commercial industrial loans of all types in blue against the consumer price index, and notably as banks tighten standards. Again, this is called credit restriction. Fewer loans get originated, less new money gets put into the economy, and all of a sudden it makes it more difficult to sustain higher prices. And what we should see and do see with a lag is the consumer price index, shown in red, now come down as financial conditions tighten. What do you see? Sure enough, financial conditions tighten, inflation comes down. You see it going into the global financial crisis. Financial conditions tighten, inflation does go up and then comes crashing down. We see it during the pandemic. We saw it in the late 80s over here. And now we're seeing it again. Financial conditions are tightening. And the Fed says this move down is not sufficient evidence when it very clearly is sufficient evidence. As far as the labor market, of course, you know we love the weekly unemployment claims. The 4-week moving average now at 245,000, almost at that marginal line of 250 that I'm looking for. The weekly claims have broken that. But look at this. What do you see? Lending standards tighten, credit gets restricted, and all of a sudden, 4-week moving average of claims goes higher. You see it again here going into the global financial crisis, tighter financial conditions, more people on the unemployment line. Pandemic was obvious, but look at it now. Nobody believes that we're going to see higher unemployment claims because of all those alleged government job openings that the JOLTS report says. But when you look at this chart again, what do you note? That it means, of course, we're going to see a much higher increase in the unemployment rate as more people hit get those pink slips and find themselves on the unemployment line. But what do we note is not just financial conditions. We're seeing it now across the globe, and this is really critical. I want to show you, we got some data today, but let's go back for a moment and look at China's data here. As we see imports plunge, export growth slows as recovery wanes. Now, when you have a country like China who needs to import a lot of things, if their imports are falling, it tells you internal demand is going down. That's not a good sign. Now, if Chinese exports are falling, and what you're going to see in this report as well, they went up off their pandemic lows, but broadly speaking, if exports go down, that means the rest of the world is slowing down. Let's dig deeper into this report. The unexpected import plunge spells trouble for economies that have been expecting China's emergence from COVID-0 to fuel their own export growth, though so far the recovery has mainly been driven by consumer spending rather than critical infrastructure and property investment, which has reduced demand for commodities such as crude, iron ore, and copper, all of which dropped in April from the prior month. And the drop-off in imports also suggests there's more reason for worry about the sustainability of China's rebound, which we had been saying is a big problem. Everyone's been pinning this global recovery on China leading the world out of the slump, and what we're seeing is they're right there with everyone else, and perhaps maybe even worse off. As imports were quite disappointing and would add concerns to China's demand recovery story, as I've suggested. Now here, look at this. They're going to spin this to say exports were aided by a favorable comparison. Keywords favorable comparison. Well, this time last year when Shanghai was in lockdown, economists cautioned that rising prices and interest rates in the rest of the world, high inventory levels, and the war in Ukraine will serve as brakes on global consumer demand, not to mention the fact that U.S. consumers love to borrow and buy things, and if banks won't lend it to them, well, that means consumer demand from the banking point is coming down. But China's strong exports can't last if the U.S. is weakening and Europe's economy is kind of flat. We know that is absolutely true. But now let's look at the U.S. data. We just got this today. And what do we see from the U.S. import and export price indices? Prices for the U.S. imports increased 0.4% in April, following a 0.8% decline in March. But check this out. Despite the April rise, the price index for U.S. imports declined, keyword declined over the past year, falling 4.8% on a 12-month basis for the second consecutive month. So what we're seeing here is imports, which really matter the most for the U.S., are on their way down. And let's look at some charts to show you that it's not just a story of banks tightening lending standards. It's a story of the entire global economy slowing, which is going to bring inflation down and potentially put us in deflation at a time when the Fed has got rates maxed out. They've got the yield curve massively inverted. The banks are hemorrhaging. You can see how we're likely to see a global, actually synchronized recession on top of a U.S. financial crisis. You've seen the seeds germinate. It's happening. Here you see the consumer price index against the import price index into the U.S. for all commodities. Notably, you see the red line leading, the blue line lower, suggesting that indeed every time you see a big crash in that red line, well, what does it mean? That U.S. inflation headline comes down following it. How about if we then zero into the price index from all industries in China? What do you see? A much stronger relationship here as the red line again comes crashing down. What does it suggest? As we know, Chinese exports are U.S. going right into U.S. consumer prices. Blue line also headed down. But one thing that's completely shocking to me is we got some preliminary data from the University of Michigan, the consumer confidence surveys, and these are critical because when consumer confidence is rising, it says stocks are going up. When it's rising, it says spending is going up. And when it's falling, well, it's not actually good news at all. Here we can see, this is again preliminary data. We see consumer sentiment fell from 63.5 to 57.7. That is a huge drop. And look at this, current conditions, 68.2 down to 64.5, meaning consumers think they're worse off. And how about this, expectations? This is down the road. Well, they don't think things are getting better. 60.5 down to 53.4. Maybe some of you think that this has something to do with the debt ceiling. I'm going to make the case that we're going to see more and more people lose their jobs. This is highly cyclical, highly sensitive to the labor market. The U.S. consumer knows there's problems. Their confidence is tumbling. Their discretionary spending is going to come down. And it's all going to happen this summer, which could be the worst possible time for the U.S. economy and the rest of the world. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.